Get started. Yeah. And if folks join in, then they can just get up to speed. All right. So thank you everyone for joining us on a Sunday afternoon to discuss investing in international markets. I'm Priyanka, and I'll be your host for the webinar. A little bit about myself. So I've been working at Google for the last 6 years in various roles, most recently in strategy and operations. And that's kind of also been my only foray into investing in international stocks, which happens through my employee stock units. And for last year was the first time I actually sold a few stocks as well, so that felt exciting. But I'm happy to be here to learn from our panelists about other options and other ways to invest in international markets. So over to Hemanshu and Swastik to introduce themselves, and if you could also tell us about your experience in investing in other countries and how you got started with that. Maybe Hemanshu, you can go first.
Sure. Thank you so much for inviting me here to speak, and I'm just a quick intro. I founded this company called as Diabito back in 2012. It was in the remote monitoring space of diabetes, and we struggled a lot in India, but then we went to the US and we started selling the product there to the payer provider market. And in 2017, I exited. So Livongo was the company which acquired us, and I ended up getting a lot of stocks of Livongo. Livongo then became a public company in 2019, and that's when I started learning more about the foreign markets, because this was like completely new thing for me. I had to even sell a lot of my stocks because I came so vesting is a taxable event, and when you are vesting you have to pay taxes, and being a resident Indian I had to pay a lot of taxes on that. So I had to sell some of my stocks. I had both restricted stocks, restricted stock units, and I had to sell some of those, and then uh, um, I learned how the US stock market works basically. um, I was not very good at investing. In fact, during my startup days, I was not investing at all. Like, मुझे तो stocks के बारे में zero knowledge था. And I went ahead and got some, financial knowledge after the exit, because I wanted to learn it, and started investing. I think I started investing in 2018 when I started building my portfolio, not only just in India but also in the US. And that led me to trying to figure out multiple other things with respect to investing in US stocks. So yeah, that's my story.
Awesome, thank you. Swastik?
Yeah, sure. Thanks. It's a pleasure to be here, speaking to all of you. Quick introduction of myself. So after I did business school here in India, I was a trader at Deutsche Bank for 10 years. So investing, trading was part of my DNA. I was a trader, a multi-asset trader there for about 10 years before I decided to start Investor, which is a platform to enable people to invest globally. For me, starting with Investor sort of originated in the fact that I had decided to get access to investing anywhere, both personally as well as on behalf of our clients. Um, and I just felt that India did not have that access, and doing it in a way which is appropriate for India was quite important. Personally, I'd been investing, I'd say, since 2009, 2010, maybe really properly since 2011 and 12. Um, I've had various theses of investing, both in direct stocks and funds, and I used to also run an ETF for a period of time. Um, but a very simple kind of principle I often held was that I had been using a set of products of companies that I really loved, enjoyed, and I really held in great regard. And that sort of stood as a very simplistic heuristic of trying to invest in those, companies that I could really feel a strong personal sense and whose brands were with me. Um, but yeah, I've been investing in fact, to the corollary, I have got a very small India-based investment and almost primarily based in the international markets.
Great. I think based on those introductions, we all know we're going to have a very interesting discussion today. And before we begin, I just want to reiterate that whatever we discuss, it's not to be taken as investment or tax advice. We'll definitely be unpacking the landscape of investing in foreign markets, but you should do your own research and consult with your CA or your financial planner before making these decisions. And with that being said, let's start off with a few basic or fundamental questions about investing in foreign markets, which is what is the need to even look at these options, right? Like why would we consider doing that when we have a lot of options within our own countries? And Swastik, maybe you can kick us off.
Yeah, sure. So there is, investing itself is always going to be a suboptimal process, right? You're never going to make the best ever return you can. That's, principle number one. The only free lunch in investing is diversification, which is that, you get a whole slightly, uncorrelated assets to invest in. And that's an important part to invest in, right? The second part is that, yes, there are a large number of companies here in India to invest, but you're speaking of a market cap of about 3 trillion, and about a 3 to 4% of the world's market cap, right? Why do you want to be playing around, sloshing in a small pool rather than the ocean of investments, right? And that's a clear thing. There's a third one specific to India, which is a second order, uh, and very few people recognize. And I've authored an article on it, and I'm very happy to point people towards the end of it as well. And this is slightly more intricate. See, India, we love our FDI, and we have been liberalizing our FDI over the last, over 2 to 3 decades. What has the liberalization of FDI done? So if you've got 100%, especially in tech companies, like Priyanka, you mentioned you work at Google. The liberalization of FDI does the following. One is that 100% ownership of the Indian domestic entity will be by the overseas entity, right? So yes, all of your domestic transactions and economy will continue maintaining your 7-10% GDP growth by virtue of transactions, but the equity growth is not getting captured domestically, right? So case in point, Google and Facebook's largest user base is India. Hey, but you can't really invest in those domestically, right? Because they under FDI. And that's the second order degree. So and we're going to see progressively more and more FDI liberalization, right? And as you see more and more FDI liberalization, you're going to have fewer and fewer opportunities to invest domestically. Your platform's already said, hey, I'm going to list in NYSE. I'm not going to list domestically. So to even access your own consumer story, you have to land up investing overseas, right? You're an Amazon Prime user, you need to buy Amazon stock. It's not here. Netflix user, so you've got all of these various phenomena which you can't access domestically. There's the other part. If you want access to electric mobility, you've got no domestic, capability. Semiconductor stocks, which as a theme, you've got no way to access them domestically as well. All of these things are extremely important. Thus, you look at investing beyond, the domestic stock markets. There's one other part, the reason why we've sort of gotten ourselves closeted into thinking about it, and India particularly, right? We're a young country, we are still an emerging economy, we've nationalized, we've got a nationalist protective regime from a regulatory standpoint for the purposes, I guess, post-colonialization. And we're not unique in that in India. But we never expected that, hey, people in India will want to be investing overseas, the world will globalize again. I use a very frequent corollary, which is of the East India Company. About 400 years ago, the East India Company came to India. It took our raw materials, sold us finished goods, but the shareholders of East India Company did phenomenally well. That's the same thing that's happening with tech companies, right? Our data is sort of being resold, and however, the equity holders of East India Companies are which are the tech majors are doing phenomenally well, right? However, platforms like ours make it possible for you to invest overseas, and thus you must be investing overseas to take care of, for your own purpose as well.
Got it. So what I'm hearing is diversification and getting a piece of economies, industries, and companies that we won't have access to domestically. Right. Himanshu, anything to add? Any other reason why we should be looking at other markets?
No, I think Swastik was bang on. What he mentioned is very, very right. That like we do have some mutual funds in India which invest in the US stock markets or other markets. There are funds of funds which invest. There are ETFs which invests in Nasdaq. But the thing is that when you actually start researching some of the tech companies which are out there in the US, or for example, if you want to specifically buy semiconductor stocks, it's a good opportunity for you to kind of go out and buy those stocks in the US stock market. And why not? Because these are future companies. Tech is growing, and they are the most progressive companies, right? And if you buy a piece of those companies, then you're setting yourself for the future. So I think it's a good opportunity to buy some of the stocks which are out there.
Got it. And Himanshu, could you tell us when one should start thinking about investing in other markets? Like, is it something that even a beginner should do, or is it something that once you're done figuring out all the products you have available domestically, that's when you should be looking at other markets? And is there any such X amount of money that you should have at your disposal to then invest, or like I said, is it something like a beginner with small amounts of money to invest could also tap into?
So I think there is no thumb rule for that. It's just based on your risk appetite, right? And I think if you were to compare the US market versus the Indian market, US market is definitely more volatile. Uh, and if you see, I mean, just last week, there was like full bloodbath in the US market. Like a lot of people were, selling stocks and coming out and not, they were all booking profits, right? Plus, also we know that U.S. markets were all the tech stocks were very, very, I would say, overvalued. So I think it just based on what your risk appetite is. So if you think that you want to make like a good amount of money in a very high volatile market, then I think you should start investing in the US market. And I mean, in order to have like a healthy portfolio, generally I've seen people do like 5 to 10% of your equity portfolio in a foreign market, and it's a good experiment to run. In India, I mean, of course, you can do it in certain ETFs and mutual funds, but those are all your long-term play, right? But if you want to do like some short-term investing and want to try out something new, then I think it's a good way to experiment and find out like how much more you can make by investing in the foreign market.
Got it. Swastik, do you have anything to add? Like any criteria one should keep in mind?
No, absolutely. I think one is that, so I'll take a few corollaries, right?
Sure.
So the American markets, people in America invest about 10 to 15% of their wealth overseas. In the UK, 60% of your wealth is technically invested overseas. All right. Now, if you look at that as a corollary, our GDPs are very similar. And in fact, Britain has got more, like a place like London's got more dollar millionaires than people in New York, for example, right? But of course, Britain's got a much longer history of spreading itself and its wings far over the world and understanding a lot more of the world, right? So that I often think that that's and there are a few reasons for this. In fact, I take exception to one point which Hemanshu mentioned. The US markets are actually, international markets and developed markets are less volatile than Indian markets, right? If you look at the spectrum of volatility, you would say, developed market bonds, emerging market bonds, developed market equities, and then emerging market equities, right? And right first up is developed market cash itself, right? You can sort of say that's the spectrum of volatility for various asset classes. So in fact, inherently investing in US markets is less volatile for you on a currency adjusted basis as well than it would be for you to go and buy in, domestic stocks. Right? And that's just the fundamental way in which markets work. As you know, in India, our stock markets are heavily dependent on FII flow. And FII flow is very heavily dependent on how the US markets and the US dollar tend to act and react, right?
Could you explain the FII flow?
Yeah, absolutely. So, you know, the regulators basically allow a certain proportion of flow into investments in India, right? And foreign institutional investors, which are called FIIs, are this whole collective of all the big pension funds or the various feeders of those particular classes into India, right? So whether it's a JP Morgan fund, which is based in the US or UK investing into India, it could be an offshore fund in Mauritius, it could be even now or more recently gift city funds, right? So these are all classified as FIIs. FII money, the reason why it is attractive is the following. FIIs don't have the traditional TDSs like we have for retail money domestically in India. And domestic funds do not have as large an asset base in totality as foreign institutions would, right? So JP Morgan Asset Management or so on will have a much larger total asset base, right? Or a BlackRock, with their iShares kinds of products. What thus lands up happening is as soon as they say that, if you're $100 billion fund overseas and I'm an MSCI World fund and I say, okay, I'm changing 1% out of India to a different market, or I'm just got a fund redemption on me, it suddenly results in a massive flood out of funds from India, right? And that results in the movement of the Indian stock markets
Yeah.
significantly, right? Because we're not really we are far more micro focused on, okay, is this a good stock or so on, but they're like, okay, doesn't matter, Sensex se paisa nikalte hain hum log, right? Because I'm just moving it into a different asset or I'm moving it into a different cash very systematically, right? And that's a big reason. That's a big reason why India, but most emerging markets stay very, very dependent on FII flow till there's an exceptionally large domestic capital base, which is very heavily involved on almost a daily basis on that asset base, in terms of the markets. So that so Indian markets, in fact, are definitely more volatile. Emerging markets generally are more volatile than the developed markets. Now, if you think of it from that point, there are two ways to think of how much to invest, right? One is it shouldn't matter. It shouldn't matter where you're at your stage, because if diversification is important, and now through platforms like ours, you can do fractional investing as well, right? We've got customers who've started their portfolio at $100, right? 7,000 rupees, you've sort of started it, right? And you can own any share you'd like. You can own Amazon. You can own a small percentage of one share of Amazon, Facebook, Netflix, Google, S&P 500. So it doesn't matter. So there's no minimum threshold bar. There's no reason for you to think, only after I've got, say, 10 lakh rupees will I start putting 10% away, right? Um, so that's how to think of it, as a percentage that, yes, day one, when you think of investing, you should think of investing overseas. Um, the percentage is also a function. There are others, and I'm sure we'll hop onto those questions later on, is the
Yeah.
operational benefit, which will help decide then when is it worth my time to invest into, sort of sending or investing overseas. I hope I gave a bit more color to what Himanshu had already answered.
Yes, I think so. So basically, beginners don't need to feel intimidated by foreign markets, and we have multiple options. Like no matter what the amount looks like, if diversification is something you care about, then it's
A
good to think
simple
about it.
principle I'd like to mention, right? This is a very famous statement by the well-known fund manager Peter Lynch. He said, invest in what you know. Now,
Okay.
by default, chances are that you know and you understand Amazon, Facebook, Netflix, Google better than you understand Infosys, Wipro, TCS, top line or revenue models, right? And that is a very strong reason, even at the most basic levels of trying to investing in what you know.
Yeah, makes sense. So I think let's try to understand the landscape of the products and the options that we have. I know we've touched upon them a little bit when we talked about ETFs, feeder funds, talked about direct stocks. But if you could give us an overview of what options an Indian investor would have. Swastik, maybe we can start with you.
Sure. So you have two ways in getting international exposure. One is on a domestic fund, which could be a mutual fund or an ETF or a fund of fund. Um, or the alternate is investing directly into. So let's just touch on the first one. You do have a few of them. They have not so low fee structures. So I'll just tell the pros and the cons, right? The cons are they don't tend to have very low fee structures. They could be 50 basis points or 100 basis, so 0.5% to 1% between direct and regular, even if it is an ETF structure. Secondly, you'll have it on the lines of a limited spread, right? You'll have 3, 4 different funds that you can invest in, right? Um, the other part is you don't have selection thus, right? So if we are saying, hey, I don't want to invest in just the S&P 500, I want to invest in just the FANG stocks. You can't do that just with a fund structure because it dilutes your total investment, right? So if you would have wanted to say put 10,000 rupees just into Facebook, you can't do that in a way, right? Because you would be taking, okay, I put in say 50,000 rupees just in the fund, and the fund will decide the allocation, right? So you don't have that access. Separately, you don't actually have access to the whole universe as well, right? There would be only these top 500 companies you can invest in, or whatever the fund manager decides is the right investment, right? So, for example, GameStop wouldn't have propped up into your investment thesis at all, right? You would not have made the gains from a GameStop. So those are some of the limitations. The advantage of investing domestically is you can instantly start. Uh, as long as you've got a mutual fund account, right? So an important part of that is that you don't need to use your LRS requirement, which is the $250,000 per head per year requirement, right? Which the RBI gives every individual. That requires you to physically send money and convert it into US dollars in your own brokerage account, even though that has now become far more simpler than it was a year ago. But still, there's a little bit of that point of friction to get over. So that's the advantage of these funds, right? We move on to direct investing. I've sort of mentioned a few of them already in comparison, but the ETFs are much lower fees. So whereas a Nasdaq 100 ETF domestically is, a 50 basis point, there it is. Actually, the Nasdaq is more. I'm talking S&P 500 is 50 basis points here. There you got the Nasdaq and the S&P 500 3 basis points, right? That you can invest in. So it's actually a 18, 19x different in the real cost of that fund. Secondly, the trading in and out of the fund is, and we did an analysis of this, and it's on our blog as well. We compared the Nasdaq 100 ETF in India, which is the Motilal Oswal fund, to the one which is internationally, the triple Q. There could be a possible 17% difference to the worse. You being worse off if you invested in the fund directly, based on the time of the trade. And that's because in India you've got far lesser liquidity, right? You're talking of a fund which is less than $1 billion in total. In the US, it's $100 billion fund, right? So you've got far more liquidity there, which means that the spreads are far tighter, the number of market participants are far more, and that's why you get a far better price when you're trading it, right? Here, also you're trading in the live market. In India, you're trading in Indian market hours, which are asynchronous to the international market hours, right? So people are expecting what the Nasdaq 100 will be if it would end at the end of day in New York when it's 2 a.m. over here, right? So it's depend on the futures price of the Nasdaq 100 rather than the real price. So that those are the factors, and of course, like we've already mentioned, getting direct access to the specific names, right? You can decide that your portfolio needs to be 25% Facebook, Apple, Netflix, Google, or you can decide that actually I don't want Tesla, or I want to double up on Tesla. Or just investing in semiconductor stocks, all of those other various things, right? ARK Innovation ETF is a very interesting ETF, which did 120% return last year, right? And it's still a fund. So you've got all these other things, and on our platform, we've got like 900 plus funds, right? Otherwise, each of these funds would need to create a version of themselves in India for you to get access to.
Okay, so the most popular options then would be direct stocks. We have domestic mutual funds which invest in either, say, the index funds of the US market, or maybe they have like a separate portfolio of companies. And of course, we can look at direct stocks and ETFs as well. And the expense ratios would probably be a pretty big factor for you to consider
So
when you're deciding.
I need one clarity here, Swastik. So
Sure.
you mentioned that the Motilal Oswal N100 costs 50 basis points, and maybe a similar fund from Vanguard would cost 3 basis points. Am I right?
That's right.
So then in that case, if the options available for us to invest from India wouldn't there be other costs which would be need to be paid to the intermediaries, because I will have to convert my rupee to dollars and then pay the brokerage maybe. So how does it work out after including all those costs?
So yeah, so the actually the real cost is only the FX cost, which should be based on the size, and we often tell our clients to speak to your your particular RM. Abhishek just messaged that I think he's got a deeper question on this as well, so we'll that we can probably delve a little bit deeper on that. But just with respect to this particular point about the separate cost, is the fact that there's even a trading cost in terms of the asynchronous nature of it, right? The 17% that I mentioned is the fact that when you're trading in the domestic markets on a future, which is on a proxy versus the real price when it's live in the NASDAQ during market trading hours, that itself can be an extremely high difference. But we'll touch upon the FX cost as well. And remember, the FX cost is something which you would amortize over the total period over which you've got that investment, right? So if you think that it's anyway going to be a 10-year thing and I'm paying 1% in FX, you think of it as an additional 20%, right? A 20 bip cost. However, you're also getting the additional part of the US dollar exposure as a currency.
Makes sense.
You get the depreciation also factored into that cost.
Yeah, FX cost is a one-time cost, but I end up paying 50 basis points every year.
Yeah. And you're having it in rupees as well. And that's the other part.
Absolutely. Yeah, sure.
And we will cover costs and charges in detail because I know that's something that everyone wants to know more about. But Hemanshu, something that you touched on earlier when you were talking about investing in direct stocks. So we have a question that, is it a good idea to invest in direct stocks to generate like an alpha in our portfolio, apart from index funds or ETFs, which let's assume like we're talking about a disciplined investor here.
So, for me, interestingly, how it was that, I've been using so many tech products these days. We are just using SaaS products like Slack. We're using Asana and whatnot. So what really, made me to invest in US stock market is because I wanted to specifically target these companies. Because I like using their products, I thought, why not just go ahead and buy those? And in fact, what I did was also I looked at their financials. I did my own due diligence, and at the time when I started investing, I thought the valuations were correct. So which is why I entered into those, and I made some really good profits on that. That you need to, even if you are trying to let's say zero down on one particular stock. Let's say tomorrow you decide that let's go out and buy a stock, let's say Apple, for example. You need to really, at the time when the valuations were, I made some really good look at EPS and all the other financial ratios, and then make a decision whether is it the right time to invest in the stock. Because any which ways, you have the option of entering into all the FANG stocks through mutual funds. But if you think that for some reason these stocks are right now valued a little less, then and if you think that this particular company probably might come out with better products, or you have some bullish thesis behind that particular company, then I think you should just go and buy some stocks which you would like to keep. So it's more like collecting a particular stock. I look at it as the same way I used to collect stamps and coins when I was a kid. I collect stocks these days. So for me, it's like that.
Got it. So like Swastik said, like invest in what you know, and like Hemanshu said, do your due diligence, which is a pretty similar approach to what we do for Indian companies as well. I think the fundamentals probably don't change regardless of the market that we're talking about. All right. So I know we've discussed the US markets in detail, but let's say that someone wants a piece of like an emerging market, or if someone wants like, I don't know, maybe European stocks or something. So do we have similar options and similar funds to go down that path, or is it mostly US companies?
Yeah, no, absolutely. And there are two things to think of in terms of getting access to the growth of a market and getting access to the stocks listed in the market, right? And we touched on explaining this in the bit of the FDI piece. So even if you think of something like Apple, 60% plus, over 60% of Apple's top line comes from outside the US, right? So if you think of, even the stocks which are really popular with yourselves, you're really getting a consumer access, growth access, which is global. These are supranational companies. More particular to your question, yes, you can get access to other stocks. So say the FTSE 100, which is the UK stock index, is undervalued in your opinion, or the DAX, which is German companies, and you get all the big German names, including the automotive firms within that, right? You have access to the DAX 30, which is the German stock index, or the FTSE 100, through an ETF in the US itself, or the Nikkei 100, which is the Japanese, or the Hang Seng, Hong Kong, and so on, right? So you do have corollaries which are US dollar denominated, and you can get access to them directly in a US listing too. And that's been the power of ETFs, which is, it's honestly speaking a 50-year story with a 10-year traction curve, if you got to think of it like that, right? Post financial crisis, ETFs really just took off, and that's been the advantage. So yes, you will get, you'll get a Brazil tracker, a Mexico tracker, you'll get a tracker of every major country also listed in the US. So you don't need to open a new account to get access to that particular market. Secondly, just like we have ADRs, like an HDFC Bank and Infosys listed in the US, you also have ADRs of specific international companies also listed in the US, right? So you'll get a BMW ADR, for example, right? My former employer, Deutsche Bank, had an ADR listed in the US, for example, right? So you will have also got these individual European or international companies' ADRs also listed there. And then you've got, ETFs which cover large groups of economies together, right? So there's an emerging markets ETF, the EEM, and you can get access to all emerging markets as a basket together, right? So yes, absolutely you can. You don't need to be opening new accounts in different geographies to get access to those particular stocks. Just like how there would be international investors looking at an MSCI India ETF to get access to India.
Okay, so just by accessing the US ETFs and US companies and stocks, we do actually get to tap into a lot of other economies and markets.
What you don't get access to is you don't get access to currency, right? So if you want access to, say, FTSE 100, but you're also taking a double whammy on, say, the GBP's performance, the pound's performance, right? You won't necessarily factor that in directly, because some of these may be currency hedged, some may not be currency hedged as well. And that's where it makes sense to try to get access specifically to those, to those geographies where you also want it in a particular currency, right? So if you want the DAX 30 in euros, you would want a European listed ETF to get access to it.
Got it. And Himanshu, what about you? Have you experimented with any of these options?
Yeah, so I have experimented with ETFs. I have experimented with specific stocks. In fact, there are some interesting options like stacks, which are like very similar to the stacks which we get in a trading account in India as well. So they've got like this different thesis to different stacks. Like there could be a stack for EV, there could be a stack for healthcare related companies, there could be stack for global investment. There is a stack for the FANG stocks that we have. So those are some very interesting stacks that you can basically experiment with. And at the same time, I've also I've been actively investing in some of the mutual funds in India, which focus on different other markets. Like, for example, there is HSBC Brazil fund. Then there is a fund for which is specifically targeted towards Greater China equity. I think Edelweiss has one. And then some few funds which basically invest in different markets like Taiwan and different growing markets. So that's how I've been like diversifying my portfolio. At the same time, I try and focus more on stocks that I like particularly, because I try and also learn from these companies how they are doing business. It's like a hobby for me. I know I keep chatting with Abhishek all the time about this. We keep trying to learn a lot from the US stocks, because when you get into the financials of these particular stocks, you come to know like what are their strategies, how they are doing and running their business. Uh, so it's fun. Yeah, it's fun for me.
It's an interesting hobby for sure. So I think Abhishek, he'd brought up a question earlier about how, I think we still can see a lot of options regarding equity investments, or equity allocation for the US markets or other markets. But are there any, liquid funds or anything like that that we can tap into, if we're looking for maybe a safer return?
So do you mean like a liquid fund like you've got in India, which primarily just invest in government securities?
Yes. Yeah,
Right.
government securities, bonds, those kind of things,
Yeah, no,
but based out of the US.
yeah, you have these are of course again like ETF structures, right? You have corporate bond ETFs. It's of course it's a slightly more intricate, you could say, spread, because you can decide to invest in just GSECs, government securities, right? And you've got an ETF for that. You've got an ETF of investment grade bonds, which you don't actually have a lot of in India, right? And you can just invest in that, and you could be getting a 1 to 3% kind of return annualized on that. Or you go even higher, which you would get into, based on the credit rating, you'll have investment grade, or you'll even have high yield, and then you'll have high yield is just a slicker name for junk bonds, right? Which are which might be giving you 7 to 10% as well. But absolutely, you can invest in, and you can get access to investing it. They haven't, the word liquid funds is a kind of a productized word for a singular asset type. And you wouldn't, for certain regulatory reasons, we would not state that, especially in the US markets, because everything is still finally market driven. So it's definitely liquid in terms of what the underlying asset is, being very similar to what it is over here. But they're not called as liquid funds, because there is a possibility of them also falling in the price. And that's because, you know, the fact that the US market is a far more market driven, right? It's not as tightly regulated as you'd have it over here in terms of what you can, what even the bond issuers should and should not be doing. That makes it far more, you could say, difficult to call it like a liquid fund per se.
Got it. Abhishek, does that answer your question? I think you'd unmuted if you want to ask anything.
Yeah, no, I think it does. The other question I had was actually, I was going to chip in on some of the earlier stuff you spoke about regarding the other markets, right? One of the challenges I've had, even when I think about diversification, within India, or even like when you look at it broader internationally, is there's sort of no end to it, right? And it obviously also doesn't make sense where out of 100 units, I just have like 1% in 100 things, because even if whatever number of them do well, I'm just averaging out too much. So a little bit of what I've struggled with is to say that, okay, I know I understand US tech like tech companies to a certain extent, right? I can understand the business, so I know I want to invest. But after that, right, how do I think about which markets to invest? For example, I do believe like I'd be long a Kenya, for example, right? I'd be long, let's say, certain LATAM countries in terms of their growth. I'm long Indonesia, with a lot of activity happening there. The foundational sort of infrastructure development happening there. So is like, how do you what's the simplest way to just take exposure to the country without does it even make sense to do it if it's less than, like, say, 2% of my net worth? Or should I then just not do it? Or if I'm thinking of investing in a country, it should be at least this much? That's been something I've been toying around, so would love to
Yeah,
hear.
it's a good question. It's something which every asset manager struggles with, which is size and position, right? And tenure of your investment. One framework which we had used and often used is what we call as a core satellite. All right. So you got a core set of investments, which from what you told me would tend to be your US tech companies plus some of the S&P 500 or so on, right? And then your satellite investments are these sort of long tail of small bets, possibly. recognizing that also, when you speak of, and Brazil's a good example. Brazil has had this massive rally, and then, Brazil's notorious in devaluing currency and sort of not being able to manage its economy well, and then sort of just all falls down again due to FII flows, and then it tries to rally again, right? So those are, again, so they can act like extremely volatile small junk stocks of the US if you suddenly think of it in that form, right? If you're normalizing everything to US dollars as a currency. So you have to bear that in mind when you think of the satellite set of bets across different currencies. I think 2%, of course, is a very decent size of if that's your net worth kind of portfolio. But I'd just say that even when you think of, one is, there are two ways to think of it. One is from a minimum position, right? Which is like, should I think, what's my minimum position going to be? Is it going to be $5,000, right? Below which it doesn't make sense for me to invest into anything, for example, right? And then you're a bit agnostic that, as it sort of scales, and you will have certain outliers, how frequently you want to recalibrate it, because rebalancing your portfolio means you sell your winners and you buy your losers again, possibly, right? That's one of the conundrums of investing, that if you have to rebalance and say, okay, at the end of even 6 months, I want to have a 50% in these US tech companies, but chances are they've gone on to become 65, 70%, and you've got to basically sell your winners. So yeah, the one framework I say is try to think of it, if you can, from a core satellite thing. And your satellite play is a mixture of small bets on things you have fair conviction on, and Bitcoin like stuff, right? Things which could go bust absolutely as well, right? Um, and I'm not professing crypto at all, but I'm just sort of saying that that's a kind of an asset that would sit in your satellite investment pool.
Yeah, I think that's definitely a useful way to think about it. Abhishek, any further questions?
Just one second, Priyanka. I just want to close. I missed one very important part. Very important to that is, and I've seen this. If you are looking at investing and you do have an important goal to invest towards, right? Then whatever you're investing towards as part of your goal investing should only be in your core investment portfolio. So do not think of your satellite investing. So say you're a parent who's starting to save up for your kids' education, you're looking to migrate, any of those kinds of things, and you know, okay, I need $200,000 by the end of 3 years or 4 years or so on. Only keep your core investments to be part of that, right? Do not include that. And it's very difficult, I know, to break your mind apart and sort of, to carve your mind into think of those particular investments as being different. But that's just a useful heuristic.
Yeah, so only experiment with a certain amount of your money, and don't forget the goals that you've already planned out for. Neeraj, did you want to say something?
No, I was just agreeing with what Swastik said, that just play with, what you can lose, and don't play with your core portfolio, which you need it for your retirement or your kids' education or anything else.
Yeah, sound advice for sure. Okay, so I want to start discussing things like documentation and process and those kind of things. Like, say we've done our, research, we know, okay, this particular ETF is the one that we want to invest in. What's the simplest way to do that? And what kind of documents or things we need to have planned out before we can sign up to invest in something like that. And this is like a US ETF, so not one of the domestic mutual funds.
Sure. So here I will also be adding a little bit, which is relatively lesser known about investing from an India perspective, right? So when we started out with Investor, I know I have a feeling there are lots of product people on the call over here, but I want to say that when we started with Investor, we just coming from the industry took a very strong regulatory first approach. Even though we like to say that our product is fair, but we had a very strong regulatory first approach, right? In fact, and this is an important piece even before you get into the documentation. And I'll be able to direct you guys to a few things to look at, which you fine print not realize importance of, right? So one is that be sure that your investments are protected, not just from an insolvency point of view, right? Because insolvency says, okay, only if those guys go bust, then it sort of is protected. But you also have investor grievance recourse, all right? Which means that on a day-to-day basis, when you're making those investments, if something goes wrong, you have a regulatory overarching body you can complain to about that investment, right? The way SEBI has got it organized is that so we assembled a very senior advisory board, including some of the top lawyers from India and from the West, to get it right across multiple geographies. So one is that investment advice. So if you're looking at getting investment advice on overseas stocks, it is technically regulated in India. And today, in our view, having looked at the whole expanse of regulations, execution of your stocks, as well as investment advice, there is no player today which is providing you regulated advice on an appropriate basis on those overseas securities, except a really small investment advisors who are regulated as SEBI IAs, right? So that's one important part. If you're looking at it on an execution only basis, so basically you decide, Priyanka, that I want to buy, Google stocks separately outside of my ESOP, or I want to buy Amazon stock or so on, right? All platforms, in fact, do not give you investor grievance protections. We do, because we are regulated by the FCA. And you will notice this in the list of disclaimers at the bottom, especially if a company is organized just as a tech platform, something happens to your order, you have no investor grievance recourse, all right? Unfortunately, a lot of people have chosen to do so just because today, under the SEBI's rules, in fact, SEBI asked me to write a paper about it once before, and they've just come back recently where we've got a small submission that we're making to them on their request as well. So self-directed investing, a couple of them are organized just as tech platforms, and you'll see in the disclaimers, hey, I'm a tech platform. If shit happens, sorry, I don't do any, you've got no recourse. And that's a really important one, right? Because if you don't have direct recourse access for a trade gone wrong, you actually have a chance of losing all of your whole investment. How we've designed it is we are regulated by the UK's regulator, the FCA, and that accords investor protections globally, doesn't matter where the customer is, right? And so even on our platform, we've got complaint processes. If we do something wrong, doesn't matter who's executing on the exchange, that's my executing broker. And in all the cases, the executing broker is an SEC FINRA registered broker dealer. All right, so that's almost a commodity that you find someone who will trade on your behalf, right? So it's really the front-facing ones who you have a daily customer relationship with that are important, because your executing broker has got no relationship except holding money in your name at the back end. But if you try to call them up, I've got a problem, they'll say, okay, speak to your front-end provider. So that's how we took a very strong principle stance in providing it very differently. And the good thing of the FCA is the SEBI really respects the FCA. Much of our Indian laws are based on English law. Our Indian regulatory laws are based on the English regulation laws. And that's why it's the closest corollary to building a platform which is regulated. Now to your documentation. So I can speak of what we think is most appropriate. What is required usually from a US perspective is just proof of ID and a proof of residence. We add on a layer of biometric checks as well. And the biometric check is just a live video KYC. We generate a random string, you have to say it out. And that is really to protect our clients and our customers. Because as soon as money is moving out of the country, your domestic bank has got no more liabilities. And you are open to all of the anti-money laundering laws. And that goes back to the same whole tech platform, because they are not regulated. They don't have any anti-money laundering rules, compliance requirements, which we do to protect our clients as well. So it's super simple. With Investor, you can open it up in 10, 15 minutes. You just take a proof of ID, which is your PAN card and an Aadhaar card, and a live video, and that sort of resolves for all of it. And then once your account is opened, which is done possibly in 15 minutes after you've submitted everything, we can open your accounts. The next step is you need to fund it. To fund your account, you've got some banks which do wholly digital, and then others which need you to fill out a paper. Today, the RBI doesn't allow me to automatically, dip into your account, right? Priyanka, Abhishek, for example, take the money put it through a nodal account and sort of send it out. A lot of like the whole UPI infrastructure does. So cross-border movement of money is very tightly controlled under LRS. And only the banks today, which you have a bank account with for over a year, are technically allowed to send that money outside. So that is still a small piece of friction in the process. So once your account is opened, we give you the details of your account and the beneficiary you need to send the money to. 4 or 5 banks have now done it wholly digitally. These include ICICI, HDFC, DBS Bank, IDFC First, and I think very soon Axis Bank as well. Right? So these 5 banks will allow you to wholly digitally send the money. And you have to set, that's the same process of setting up a beneficiary and keep sending it as well. On Investor, we've got, once you become a client, we got a whole detailed list, and I'm very happy to share the link as well of funding your account for each bank by bank. And we've also got, pre-filled forms. So those forms already have all the details except your bank account name, PAN card number, address, link to that specific account to sort of send the money out. And that's it. Usually the money will reach between 1 to 3 days. Most of these banks, if you send the money before 2 p.m., you will have it at the latest by next day, start of day in the US, but very frequently even start of day in the US on the same day as well. So we've seen clients 2 to 3 hours after opening their account, their money is already sitting in their US accounts the same day. So yeah, so that's a very quick sort of piece in terms of and then the money's hit your account, you'll see it reflect and you can start investing.
Got it. I think that's a pretty useful summary. Hemanshu, when, with the experiences that you've had investing, how easy or difficult did you find the process the first time?
Yeah, so I use a different platform. I use StockCal, and for me it was very easy. Again, like I think it's very similar to how Winvesta also works. Very simple KYC, and once your KYC is done, you can immediately LRS the funds. Now, as he mentioned that you can do it digitally, you don't have to fill out like a paper form. Earlier when I had started, there were the net banking option was not there, so I had to fill up the LRS form, which is also automated. I mean, most of the platforms like Vested also does the same thing. It just helps you to completely automatically fill the form. All you need to do is just take a printout, make a check, and ask your relationship manager to come and pick it up, and they just do the LRS for you. It takes 24 hours, 24 to 48 hours to kind of reflect the money in the US account, and as soon as it is there, you can just start trading. So it's very simple, I feel.
Okay, as someone who hates paperwork, I'm glad to hear that it's all digital now. So
Yeah.
I think within this process, if you could tell us a little bit about where the costs come in, like what kind of charges or fees and maintenance charges, etc., that we should be careful about when we're starting off the process.
Yeah, Hemanshu, you're on mute. You're saying something?
Yeah. Hello. Am I audible now?
Yes, we can hear you.
Yeah. So so there's I think 5% TCS which is being charged these days. I think it was not there earlier, but I think post September they put a new tax, which is like tax collected at source. If you do as soon as it is there, there's I think it takes to kind of so it's very simple. Now, yeah, it's being charged these days. They put a new tax, which is the time when you are sending out funds. That is a charge. Most of the trading platforms which are available, they have a certain charge for every trade that you make. I mean, it's the same with most of the platforms. I think so 1 cent per trade for me, because I've taken like the gold membership. So you end up paying like 14,000 rupees annually to sort of help them. I mean, they help us managing this entire portfolio of stocks on their platform. So I think that was the cost. Apart from that, it's just based on your long-term and short-term capital gain taxes that you need to figure out based on your tax deduction slabs. And yeah, I think those are the ones that you should look out for. I think maybe Swastik can actually tell more
On the
because the platform. Yeah.
So on the tax front, slabs don't matter here because you are charged long-term or short-term capital gains tax. One thing to note would be if you're investing in the Indian equity markets, short-term capital gains is at after 12 months you're charged long-term capital gains, and if you sell it within 12 months, it's a short-term capital gain. But if you are out investing in stocks directly outside India, it's 24 months. The threshold is
Yeah.
24 months to make it a long-term capital gain. And
Correct.
also another thing to note is that if you're investing in ETFs in India, or say Motilal Oswal N100 fund of fund, it will be taxed as a debt mutual fund, and it won't be taxed as an equity mutual fund. The threshold for a mutual fund in India to be taxed as an equity mutual fund is 35% only. If they have anything above 35% outside India, it's a debt mutual fund.
Yeah, so I'll just add to all the thoughts over there. The first one is that the cost. There's a real cost of FX. We touched upon that,
Mm-hmm.
right?
Yeah.
To send money, banks break FX into two parts. One is a fixed fee and a spread. This fixed fee varies anything from 0 to 2,000 rupees. Axis Bank is notorious in being a bit more expensive. You've got some of the younger banks, DBS, I think, does it even as little as 100 rupees as a fixed cost. The spread varies. There are two types of ways of thinking of spread, and this is really where if you have a relationship manager, it matters. So banks have an internal method which they call as rack rate. And trust me, of all the things that I'm going to say right now, X tax, this is the most important part, like day one in saving costs, right? Call your RM and ask him what's the rack rate size. The rack rate size varies anything from $5,000. Basically, they'll say, agar aap $5,000 ke minimum se kam karoge, right? My hands are tied. I can't do anything to help you. But if you, and this is what varies. It says $5,000, $10,000, or 10 lakh rupees. These tend to be the various ways at which they call it a rack rate. If you send money anything above their rack rate, they can give you up to an 80% discount on the spread that they would charge you. So if they say they'll charge you 1%, they might give it to you for 0.2% as well, right? So that is where it really makes sense to give your RM a call, and it's very easy to get a 75%, 80% discount on the spread that they're charging you on that rack rate, above that rack rate. The
So if
TCS,
sorry, so just to clarify, so if I'm planning to do the transaction with HDFC, I should call up my relationship manager, ask them the rack rate. Is that what you said it's called?
what is the rack rate and rack size kahan tak hota hai, above which they give discretion, right? The second thing is that even when you speak to them, so very simple ways, they will tell you, I have to charge you 1 rupee on every dollar or something to that effect, right? Or 1
Okay.
rupee paise. That's the language in which they will speak to you. So you can get it down to saying something like 25 paise per dollar, 30 paise per dollar, right? Is the cost. That's the language you can use, which is the default language. Then the second part is about TCS. TCS only kicks in when you have sent over 7 lakh rupees in the year. So for the first 7 lakh rupees, you have no TCS, which is 5% tax collection at source. Above that, say the next 1 lakh that you send, us 1 lakh ke upar, it will be 5% TCS. So, and that's a tax collection at source. That's not a tax deduction at source. What's the difference? A tax deduction at source is कि you have to pay this tax, right? Government को ये पैसा जाएगा ही. You have no way to reclaim it in the future as well, right? You can gain a credit against another tax deduction at source. You could do it. A tax collection at source is different, in which it says that I am prepaying tax. If in the future I realize that there is zero tax I've got to pay, I will get all of this money back. All right. So that's the difference between a tax deduction at source and tax collection at source. They often get commingled in their understanding, but it's an important one to distinguish. So, what it says is, say if your only source of income is your income in India, and you've already paid, at income tax deduction at source under your income tax, you've already paid your whole thing, and you've not liquidated any of your international investments, right? you can receive, you can already say, I've already paid this 5% and I want this 5% back wholly, right? Because you've already paid your income tax collection at source plus your TCS, so you can clear back. The TCS was introduced for an audit trail by the government. It wasn't introduced as a tax collection format. The government realized that a lot of people are sending money out of the country without a PAN card as well. And so they instituted PAN card. But then they realized us PAN card ke upar, they're not even paying domestic tax. So they started collecting this to improve domestic tax compliance rather than sending money out, right? So that's the TCS story. On the income tax collection, on the taxes in the US, you've got no capital gains tax, right? You have, under the double taxation avoidance agreement, a 25% tax collected at source in the US on your dividends only. And this is for a person who is what's called as a non-US person. A non-US person is basically most people in India, unless you have a green card or you're a US citizen. If you have a green card or you're a citizen, you will need to pay US taxes and you will get a 30% tax deducted there, plus capital gains taxes. The additional part that is important is, yes, you do get long term and short term, but you also get the benefit of indexation on the rupee. All right. So on the US dollar. And that is quite valuable. It can sort of, over a period of 2 to 3 years, you can get an additional 10% over your original sort of tax. So think of that part, and the income tax act has got this particular reference where it keeps telling you what the new latest piece is. So I think Pramod just asked a question, and I believe that is right, subject to indexation on India. All right.
I have a question here, Swastik. I guess since India and US have a double tax avoidance agreement, wouldn't Indians be liable to pay a differential tax, so after what they have paid in US?
Yes, that's on the dividend. So you only have to pay the differential tax on the dividend. On capital gains, the US is not charging you any taxes, right?
So we only pay in India then, only in India, right? Yes.
Sorry, Swastik, then what is this 25% tax that Pramod asked that you said yes to?
That's only on dividend.
Dividends.
Got it. So the 25% tax at US is on the dividend. And when I liquidate the asset, whatever capital gains I have, that's short term versus long term, along with.
So let's say, simple example, right? So say you have not liquidated any of your investments. You've received 25% so say you just received, you had received $1,000 as a dividend, and then you had to pay $250 away, right, as a dividend tax in the US. Now, if you recognize under your domestic tax is to realize that on your income, that I'm in the 30% income tax slab. I can't remember what the new latest income tax slabs in India are, but it's just say 30%.
Marginal
then
rate
on that $1,000, you would pay 30%, so $300. You have to pay a marginal $50 in India equivalent.
Got it. And okay.
Yeah.
Got it. Now, something I've been thinking about from a taxation perspective, and Swastik, this goes back to a conversation you and I had very, very long ago when you were, literally just starting out with Investor, and one of the reasons why I think you started, right? So most of us, who are on the call and like peers today, we have international travel happening at some point, right? And we have expenses in the US or internationally that are going to happen at some point. So what I've been trying to figure out is how can I kind of invest in the US? And when I liquidate some of the stocks, which, let's say at one point I know that let's say I go to London or New York tomorrow, right? And I know that, hey, Tesla is super, super valued at this point. I'm happy to do some profit booking, sell it, and use that money for part of my vacation expenses. How can one make that mechanics work? Because I don't think I can like use my brokerage account to kind of run the expenses, right? And if I'm not an NRI, how do I manage this? Because I think what that also does is, to extend the line of thought, is it helps me liquidate some of my stocks, book the profit, but also not have to get it back to India to pay tax on it.
Okay, so 2 points over there. Your taxes are not dependent on your remittance back to India. You incur tax on not just on just crystallization of the taxes. All right. So even if you continue holding that cash overseas, right, that you've liquidated, your tax incurrence actually happens by the end of the tax year if you've just booked a profit. That's a misunderstanding a lot of people have. Ki this is only when I repatriate it that I need to pay tax on it. That's not how it is, right? Back now to your first question, how can I reallocate my liquidation of those assets in any other way for foreign expenses or even for a foreign asset reallocation, right? Say you got a friend who's starting up and you want to invest in that startup, for example, right? Um, we are coming up with a solution for that by giving people international bank accounts so that you can then liquidate it and then continue holding it overseas. Um, and fingers crossed, next few weeks we should be launching our first set of accounts for it. We're looking for early users, so if you guys want, you should be, we'd be very happy to extend this out.
So
There are,
Swastik, uh,
yeah,
I have a question here. So that means that we can withdraw money in US and spend that money there. Taxation is another aspect. Let's not think about that now. But I will not incur any conversion charges at all in that case.
that's right. That's right.
Okay.
It's going to be a multi-currency account. You'll be able to hold like 30 plus currencies, not just US dollar, but
Okay.
over 30 currencies.
And one more question on the dividend
Yeah,
tax.
I want to
Sure.
close one piece out, Abhishek, which is that the US regulators have become extremely tight in sending this money to anywhere else other than where it originated. All right. So if it came out from your HDFC account in India, more and more brokers have become very, very wary of sending it anywhere other than that. And we had a case recently where a client wanted to repatriate to his other international account, right? Um, and the reason is the following. It is, general speaking, like you'd have I'm not 100% sure, but I believe that most brokerage accounts in India will tell you अपना एक account link करो, उसी में वापस पैसा जाएगा, right? And you have to sort of keep moving the money only from that account to your brokerage account and back.
That is because it becomes very easy for them to report it to RBI, right?
No, that's not only true. We are AML, we are regulated under anti-money laundering requirements as well, and that's a classic term. There's something called as the washing of money or the layering of proceeds. And the only way for an entity that's regulated as a broker to ensure that there's no layering of proceeds and washing of proceeds is to send the money exactly back to the account from where it originated. So that's in that.
Then does it mean when you have this account, I first have to transfer to your bank account and then wire from it to the broking account?
That's right. That's what it would result in. If one is looking to make this on a slightly longer term kind of scale as well. And the two reasons for this, which these are very recent. One, the GameStop phenomena. The other is Bitcoin phenomena. A lot of people were sending money from all over the world to the US to try to get into the GameStop story, and they tried liquidating it, trying to sell it all over. The US regulators just clamped down on that part. So that's that's one other piece to just be wary of if you're looking at robustly building an international portfolio for investing as well as expenses.
Got it. I know we're sort of stretching on time, and especially
Yeah.
Swastik, Hemanshu, and Priyanka. I know, like, anybody has a hard stop, please let us know. Just also wanted to open it up to everybody else. Nitin, Vivek, Pranav, Aditya, Komal, would feel free to sort of chip in your questions. Yeah, anybody has anything that's annoying Swastik and Hemanshu as much as we can. Priyanka, I think any specific questions that more we had to cover from whatever we collected?
No, I think there were a couple of miscellaneous ones like if Indians are allowed to use Robinhood, if they can use that platform. Maybe Himanshu, if you've experimented with that or if you've ever tried to.
No, I don't think we are allowed to. I mean, I've never tried it, but I think it's not even listed in the App Store here in India, right? So
Yeah,
I'm not
you're
sure
not
if
allowed to because Robinhood can only take on US persons.
Okay.
And that again goes back to the original point that I was mentioning about regulations. Technically speaking, the SEC is a very tight regulator. It does not want even SEC regulated entities going out beyond their remit. And so, you've got others like who are SEC registered investment advisors who are going significantly beyond their limit. And you'll actually see that in the disclaimers. As an SEC registered investment advisor, technically you should be taking on clients only in your state or anyone that you do on a reverse inquiry basis. That's the very, very sort of murky part then to get to. So, Pratik, who's my co-founder, is SEC regulated himself. And, we recognize that there are certain challenges. What will happen is if you land up even trying to become a client of an SEC regulated entity, which is not appropriately regulated in the local jurisdiction, you can have a freezing of your accounts. That's happened before. Your account could just get frozen because the regulator will go back to them and say, I need to do an audit on all of your flows. You can't send any money out. You can't send any money into that account any longer. So kindly pause all business. That may result in quite a few different issues to the end customers.
Got it. Yeah, we have, if you could just confirm this from Pramod. So he's saying, so the drawdown is from the brokerage account to the local bank account, similar to how crypto allows you to transfer funds to your bank account. Is this the correct understanding?
Pramod, maybe you can unmute yourself and ask the question. I didn't get your question appropriately.
Yeah, so Swastik, the basic thing I was looking at is on liquidation. It basically gets credited to the brokerage account, say if we invest to investor, and then the transfer can be drawn down to the local bank account. That's the way it will work, right?
So when you say local bank account, now you mean that your international bank account, which is local?
The international bank account. Once it's.
So we like to call it the international bank account from the customer point of view. So that's how it would do. Also note that the accounts we are creating are actually not in the US. We are creating these accounts in the UK. And the reason why we're doing this is because if you land up having a US account, you'll end up needing to file taxes separate to your W8 Ben, which, and I missed that part, Priyanka, in the early parts on as well in terms of the onboarding. If you are that account accrues any interest, you'll end up having to file local taxes in the state of the branch at which your account is based. All right. You don't need to do that if we create your account in a place like the UK, which of course is a far more vibrant place. Also, you get the additional capability of holding multiple currencies, which the US does not allow you to do. So most US bank accounts are only US dollar. They love their currency and very, very few others. So which is why we create your accounts in the UK rather than the US under the FCA's regulations.
Okay. And if the same amount has to be repatriated from the international bank account to India, it will be like a cross-border remittance transaction.
That's right. Yeah.
Okay.
Swastik, hi. So Pranav here. Just wanted to understand, what do you recommend in terms of, if suppose one really wants to do this, what's the sort of minimum number that you recommend? I know you said, you can start with $100 and that sort of stuff, but frankly, this is a process, right? And it has costs and it has attention costs also. So what do you recommend in terms of, starting out with a ballpark number, so for example, once I decide that, okay, this much lakhs is what I want to really play around with, that's when I should consider this.
Yeah. So, Pranav, I will actually say that we've seen customers who have done the following, right? I will take a few empirical examples, and we've seen quite a few different versions. One is the customer said, hey, is this legit, right? Can we really do this? Because just like the questions you've asked, we've got customers who sort of come in, discover us and say, is this even legit? So they put in just $100 or $200 to start with. And then soon after they've become SIP-like investors, putting in about $1,000 to $2,000 per month, right? So I would say, however you're investing domestically, do start looking at that international investing space exactly the same, because you get the option of dollar cost averaging as well, right? If you're a local SIP investor in mutual funds, do it similarly over there. And these markets are very, are relatively expensive, generally speaking. But at the same time, the US investing also is very K-shaped. There's a lot of value still, especially in travel and real economy companies. So one is that I would say, think of this from the get-go as a necessary point of diversification, agnostic to size. I wouldn't say, only once you've decided to put 5 lakhs or 10 lakhs or so on, should you go ahead with it. The second part is that you're actually dealing with 2 points of friction. If you've never sent money abroad, you're firstly dealing with LRS as a process itself. And the second part is actually then doing the asset allocation investing separately too, right? So my suggestion would be that to deal with both of these points of friction, and I find that especially if you're an ICICI or HDFC customer, right, it's become quite quite sort of systematic for most of these customers who come up to our platform and are making a monthly kind of investing out there. There's going to be one more piece, which is the IPO season. And we are likely to continue seeing a lot of IPO flow. A lot of our customers are, for example, sent money at the Palantir IPO, the Airbnb IPO, Snowflake, Affirm, right? So it's always good to actually not just land up getting fully invested, but already have a bit of corpus if that is a kind of thing that you want to be investing into as well, right? And even we tell people that given how where the markets are right now, do not get fully invested from your US dollar corpus. Probably keep a 15 to 30% in cash, because yes, you get whatever momentum there might be, but when these markets would fall, we'd expect that they would that's where again value will get rediscovered.
Cool.
But I'm not
Absolutely. No, makes sense. Just one point. So you talked about the LRS. You talked about in terms of the whole investment part or the sort of allocation part, but the third part being the compliance part. So you think that's some friction out there, or what are your thoughts there?
Yeah. So up to the $250,000, you have got no personal compliance requirements, right? All of the compliance for LRS has to be undertaken by the bank, your bank. So, and that is automatically taken care of when you land up filling your Form A2, whether it's digital or the form-based process, right? So when you enter your PAN card, the bank has to land up sending a daily end of day feed to the RBI ki is PAN card pe itna limit abhi use ho gaya hai, for example, right?
Understood. No, what I meant to say was also on the whole, assuming there are gains being realized, right? So there would be the whole the taxation bit, right? So all of those compliances in terms of the annual reporting. Yeah.
Absolutely. So for tax, by the way, we produce your tax statement for all of our customers. There is a small difference because your tax season in the US is calendar year, and here it is an additional 3 months as well. So, but most people will take that tax statement and give it to their CAs and say ki itna mera crystallized profit hai over the full year, and you've got a detailed transaction history of all of that, right? Plus taxes that have been deducted through your dividend taxes as well. So your compliance can get trivialized by just literally downloading these statements and giving it and saying this is my total taxes that I paid and these are total capital gains that you've got. So that is in fact, based on also what Neeraj mentioned, right? The tax compliance calculation is far lower as a bar for your international investing than it is for depending on the whole slew of schemes that you've got available in India to comply with your domestic investment tax sort of planning. Because there's straightforward long-term and short-term, and there is the dividend already withheld, right? That's it. There's no other complexity to it.
Understood. Thanks. Yep.
Swastik, we have a few questions in the chat box. Maybe we can get through those quickly. So just on the dividend tax, is that deducted at source or do we need to pay it when we're filing our?
The 25% is deducted at source. The additional based on wherever you are here is, whatever you need to do at the end of the year. There's no deduction at source.
One question here, Swastik. So say for example, someone who is in a zero tax bracket in India and ends up paying 25% tax on dividend, how does US taxation work? Do they have any kind of refund opportunity there?
Actually, the US wouldn't, but under most DTA, India will be required to give you back the tax credit as part of your next, and will just accrue as tax credit.
Okay, so we claim it as a tax refund in our Indian income tax returns.
That's right.
Interesting. And has it worked? Have you seen it working?
It's unlikely. The people who are investing already are paying, shitloads of tax.
Yeah, sure.
So it's a nice place to be if you can be that. You need to have a Jersey residency, be an NRI, and be spending a small amount of time in India and be investing in the US markets to do exactly what to land up in the place which you are.
Thank you.
So there were some other questions as well. Happy to take them.
We have a question about WinVista and the kind of research reports that you write. Then we can take Pramod's question.
Sure. So actually, there was also another question about participation in
IPOs.
Yeah. So we yeah, you can't participate in IPOs, unlike in here. But what we do have is, as soon as IPOs are listed, we list them on Investor. So at start of Bell, we do have IPO listings at Investor. So that is, of course, always a frequent draw.
And that's when you were saying that you encourage people to keep some funds set aside so they
Right.
can.
Like literally, as soon as Palantir went in, right, you can have the order in at 7 p.m. India time or 7:30, right, and sort of be in that investment or so on, right? Airbnb is proven to be
Is that something
very,
that's unique
very.
to Investor? Is that something that's fairly common across platforms?
Say that again. Is the
Is that something that's like unique to Investor in terms of the IPO thing, or is that kind
so
of
it is.
common
Yeah, I would
across
say it is
like other?
to us.
Yeah.
But you do need to do a lot of operational work at the back end to ensure that the IPOs are getting listed ASAP. And we do that. That's I'd say just the distinction, that we do take care that we keep customers informed that this is happening. We have a story about it as well that we tend to publish in advance of the IPO, so that people get a bit more informed. So we have a daily newsletter, by the way, which is called Investor Crisps, which covers one particular company every day, usually a newsmaker from the previous day, to help you build awareness as well, right? And so, in fact, very interestingly, we covered GameStop when it was less than $18 back in December. We've had customers who ended up buying it, and we do have a loyal base of customers who look at that Investor Crisps, and that is what we have. Is, we'd say, very lightweight research. It's about a 2 to 3 minute read every day, and that's what we proxy up for research as a newsletter. It's got a bit more, we intended it to be for the Indian audience, but it started getting a bit more global distribution as well. And we just try to keep it in very sort of simple language, and we give you the top indicators of the S&P 500, Nasdaq, domestic indices, dollar, rupee, for example, all of that in it. So to Neeraj's question, we don't offer research directly, but that's one form of investor awareness. There's a second one. We provide you with third-party analyst ratings, right? Now, as you know, generally speaking, in India, but again, we learned from the rest of the world in this, there's becoming a segregation between execution, investment advice, and research, right? So in India, you've got an IA license, you've got a broker, you've got a research analyst, right? In the West as well, you've got now requiring significant distinctions. So we stay as a broker, and thus give you all of the investor grievance protections as a broker, while partnering or creating analysis or aggregations of third-party research, right? So as part of third-party research, we provide you analyst ratings. So across approximately 100, 120 securities, we've got a list of how many research analysts are covering these, how many are saying this is a buy, sell, or a hold, right? So what that helps is you discover new stocks. People would not know of Etsy, but it is one of the highest rated stocks in the world, for example, right? People will be piling into Tesla, but don't realize that only less than 30% people say it's a buy, right? So we help you sort of make those decisions on a self-directed basis, right? So that you can do it. But I've got two recommendations on research. One is Seeking Alpha, and the second one is Yahoo Finance. Seeking Alpha is a freemium like piece. You've got a lot of views on both sides. You can build your own portfolio, sort of keep tracking it as well, and then you'll get a list of that. We do also have a small newsfeed in Investor, but it's just newsfeed, and it is not for the purpose of engaging as part of research. So analyst ratings, Investor Crisps are our internal modes for providing research, and we've got recommendations like Seeking Alpha.
So Swastik,
Okay,
I had a question. I wanted to know, I've seen on a lot of platforms, they don't allow you to buy stocks of companies and some specs that have, a market cap of less than $1 billion. Any specific reason why this is not, allowed for investors based out in India?
So it's not just for India. It tends to be for most people from outside the country as well. So $1 billion less awkwardly comes into like the penny stock space as well, right?
Yeah.
And what happens is that As an executing broker, you do land up having a little bit of reputational risk because for small market cap companies, you have a very wide bid-ask spread, right? Um, that bid-ask spread does two things. One is it opens you up to a bit of rep risk in terms of, if you saw the market at a place, but there's not a lot of volume being traded. But the second one is fractional shares, because the fractional shares requires it to be a very liquid market. And you can't provide those fractional shares in the absence of a liquid market because the bid asks are not tight enough.
Okay. Got it.
Right. That bid ask part is a bit more intrinsic because, when you're buying a fraction of a share, it's not trading on the exchange. The broker is making an assumption of what the real price will be. And that real price is very skewed if the bid ask is very wide, and the broker ends up taking a bit of a risk on book because of that.
Got it.
Yeah.
Got it.
All right. So, hey, sorry, Priyanka.
Oh,
If
sorry.
again, okay. Just one quick question. One is regarding Investor, right? So first of all, the concept of having or you folks are launching a new thing where you're going to be giving us international bank accounts is awesome. And is that going to be the multi-currency accounts? I was just going to the website and looking at all the ones to sign up for it. So is that the one? Okay,
That's right.
perfect. So I'm looking forward to signing up for that first. And secondly, and I have spoken to Hemanshu a little bit about this offline. When or does it make sense to open up an entity outside of India and invest via that entity, right? So does it make sense to open up a private limited somewhere in US or Estonia or anywhere like that and invest via that instead of us having to deal with all of this load?
A good question. I'll take them both on. So actually just the MCA is right. And we'd love to. And Abhishek, I can probably send a form out. It's not wholly ready yet, but
Yeah, I think we need a summary now so people don't.
Yeah. We'll send it out like super quickly as well. But
I'll ping you on Discord about that. Don't worry, I'll disturb you till I have access to it.
Yeah. So on the entity part, right? You can invest through an entity. The ways to invest through entities are the following: either open it as a corporate structure or as a fund structure. A fund structure will be managed by a financial institution like us. The corporate structures will be managed by someone like, you and Hemanshu, and if you guys get together, for example. The fund structure doesn't have significant requirements on you to become an investor into it. It has it on institutions like us. A very strong one with respect to India is what's called as a place of business issue. And that's the reason why, even a lot of actually, the reason why you're not actually allowed to invest in international mutual funds, and international mutual funds will deny you access to investing into them, is because of this place of business issue, by the way. Sorry, minor diversion. But that if you land up investing in an international mutual fund, be open to accepting that they may decide one day to liquidate your investments and throw you out. There's what's called as the rule of 200 in India. Which is that if more than 200 people are solicited in India for a financial instrument, that legal entity needs to have a place of business in India. Now back to your question: if you do decide to open, say, a UK incorporate entity or an Estonian company, right, and you decide to invest through that, you've got two things to be wary of. One is that will that entity be able to open a bank account in their name, right, for you to deposit funds, right? So say Nitin, Himanshu, you guys become directors of the company, but you're not resident in Estonia. And of course, Estonia has got this e-residency program, so you might be able to get a bank account in the name of that entity that you create, but be ready that, it opens itself up to significant anti-money laundering requirements. The UK is also similar, but the UK will tend to say that, you must have anyone with more than 25%, you must have at least one local resident, possibly being a director of the company. Right? And that's the part to be wary of. From the Indian point of view, actually the entity structure makes a lot of sense. Why? Because LRS does not really come into the picture if you also have a local entity in India. So then the rules move from LRS to ODI. And under ODI, if, say you decide to open a small India entity and uska subsidiary you make an overseas, then you can remit up to 4x the balance sheet of your India entity. You can borrow money and send money overseas. So under LRS, RBI doesn't allow you to borrow money. Under ODI, you can lever yourself up to 4 times, take money from, even borrowing or whatever if you've got, and send it overseas, right? Um, and that what that does is it removes the 250K limit per head from you to sort of looking at investing. But yeah, that would be a reasonable way if you want to, avoid the 250K limit and get into investing it under the ODI structure, which is overseas direct investing structure.
Got it. Thanks so much.
Pramod also had a question. If you,
Yeah,
Pramod,
sure.
if you're there.
Yeah, Swastik, I'll just explain it. Whenever you make a cross-border payments from your international bank account, can we use the purpose code as investments? Because effectively, this is what money you have made out of your investments. And whenever
Yeah.
you do an inbound payment, the banks or the payment providers in India are very specific about the purpose code of payments.
That's right. You can. I'll just, there's a specific purpose code as well, for when you sort of receive money back into India. And you should be able to, figure that out very, very easily, in your bank. So if you won't see it when you're doing the digital payment, because that you need to know what the specific one is. But if you look at the physical form of your Form A2 itself, very frequently they don't just tell you the outbound receipt payments, they'll also tell you the inbound receipt sort of purpose codes. And actually India is far, far more prolific in all the various ways it's ready to accept money into the country than it is in terms of sending money out of the country. So I'm confident I've seen that specific, purpose code. And it should be quite, sort of self-explanatory as well when you receive it.
Okay, thanks. And additionally, in terms of cost, as and when you make the cross-border payment, you'll also have to factor in the FX cost at that point in time. Right?
That's
From
right.
an overall, it's not only the cost, of sending the money for making the investments. You also have the taxation aspects and also the cost, the FX cost that you make while making the payments inbound into India.
That's right. So you have FX cost. The FX cost is, by the way, the FX cost for repatriation is usually much smaller than the outbound cost. And with the bank accounts that we're looking to provide, we will be looking at also helping you control that FX cost itself and be far more transparent. That's one of the challenges with Indian banks. They're very, very opaque in their FX cost till, they've already charged you for it, right? We're trying to make it and move it towards a 0.5% FX cost whenever you want to, receive money back into India, and also reduce your fixed FX cost, which is, for sending money out from the US back into India, possibly getting that fixed cost down to zero as well.
Yeah, because usually banks or payment providers basically, expect the senders to make the charge payments. They don't usually tax. They don't want the fees to be paid by the beneficiary in the traditional, inbound remittance market. So out here, okay, if I'm sending from my local international bank account, I have to be bearing the fee. Okay, now this is where the your partner bank from where the payment would be made. Okay, how they have an agreement with your the downstream Indian bank who's actually receiving the payment, that would come into play, right, to influence these entire fees.
No, that's not wholly true.
Hmm.
There. So one is, remember that the US banking system is very archaic and inefficient, and that's why they load on a significant amount of costs nevertheless, right? Because the same example that you took, if you're sending it from the UK or Europe to India, you've got platforms like TransferWise, Revolut, etc., which have really Zoom Pay as well, right? Which have radically reduced World Remit and so on. And we sort of have built something very similar as well, so that you keep it all wholly in. The reason why the costs are high, and even the reason why, when you send money out of the country, there is the banks are required to pay SWIFT, which is a third-party private entity also owned by the banks itself for maintaining cross-border flow of money. And that SWIFT payment is broken. Sometimes they say, okay, I'm just going to take the cost of SWIFT. And that cost of SWIFT depends on the membership of the bank. It can be as little as $5 per transaction to even up to $15 per transaction, right? That's usually the reason why there's a fixed cost in it. If the value becomes large enough, they mitigate it by absorbing it in the FX spread, so it looks pretty small to you then.
That very much leverages the correspondent banking relationship, right, globally, the SWIFT network. And it also does not necessarily provide you, immediate, it's usually T+1 or T+2, using SWIFT. That's where you have new platforms like TransferWise and all, which gives you at least, same day or less than same day, settlement, wherein you're actually realizing the funds, okay, with a better service overall.
That's right. To an extent, there is a small complexity when the country is capital controlled like India. So you see, the reason why TransferWise took off is what would be considered as a Hawala scheme in India. The TransferWise said, I will move it locally between GBP, and you do local euro transfer out, right? If you were saying that in India, that's Hawala, right? If I were to sort of give you money in India and you'd say, okay, to my friend, I'll give it in the US, right? So TransferWise model was slightly different. Of course, it's needed to live to also moving money primarily now into emerging markets, which is their biggest sort of source as well. But the correspondent banking network is something which is slightly still a bit more archaic. What Swift has done is it's helped level the playing field out. This is now becoming very technical for a lot of people, but that's the reason why these FX costs are high.
Yes.
The concept of having intermediary banks as well is sort of dissolving itself away through these kind of newer frameworks and the kind that we are building as well.
Just, I think something to maybe take further on Discord later between all of us would be that we can just figure out what banks we're using. And I know there's a friend of mine who was suggesting doing this. He has fairly large ticket remittances outwards. And, even going back to the rack rate thing that Swastik spoke about, if, there's a bunch of us on it, for example, ICICI and a bunch of us on HDFC, we can kind of go together and say, what, this is all of us, and we're doing we're wiring so many $1,000 on a monthly or a quarterly basis, and either give us a better rate or we're moving to quota.
Actually,
access.
we love to sort of.
Does that work?
Yes, it does work. I've heard from a friend has done this and he's pulled it off for himself and a couple of friends. So maybe it's anecdotal.
Yeah,
maybe
it works well on the rack rate effects. See, at the RM level, it is still very unsystematic, unfortunately, right? He will miss it once, and then unfortunately, the banks don't seem to get it, right? Because they know they've got this captive audience, and they will continue using this captive audience, continue using them. So they don't care two damns about it, unfortunately, right? We have partnerships with ICICI, with HDFC for a whole host of various things, right? And because of the product that we've got, they're getting a lot of flow as well, but they're still very, you could say, hard-nosed about making concessions. But yeah, I think, at the best level, that individualized RM thing, in fact, we say it very clearly on our funding page, aapke paas RM hai, to please usse baat karo, right? There's a few other phenomena which the government is trying, having a central clearing for FX. It hasn't really taken off, unfortunately, again, due to the coterie of the big banks. So, but back to the point, Abhishek, that you were mentioning, we are actively also looking to build something which can be unified, so that you don't need to go through individual banks to do this and still get a far better rate than what they would provide you otherwise. At 0.6% rather than the 1 to 3% on average that they would tend to charge you.
Please build faster. Let me know if I can help with hiring anybody.
Oh yes, please. Okay, I'll get that through to you. But yeah, that's a little bit of a challenge right now. By the way, I think there were a question about costs as well, and I'm happy to mention the costs that we have on our platform. We don't have any AMC costs. We don't have any minimum commission per month. We have a flat, everyone gets 3 free transactions and then a flat $1 cost, agnostic to size of transaction. So that's, we're looking to add different levels as well, particularly a subscription-like fee with unlimited trading too. And then, when we've got the bank account, we'll help you mitigate and reduce some of the total cost you're paying as well with that. But yeah, those are, so you can literally open your account today within 15 minutes after, and just, get rolling. I'm happy to share I'll share a promo code as well, which you guys can use. We'll give you $15 credit the first time you guys fund your account. Any of you here or as well as some of those who will receive this recording and couldn't have made it too. So, so yeah, that's the first time, once you've funded your account, we'll be happy to give you guys at least that first kick to help you mitigate some of the costs of doing that.
Yeah, that'll be great. Please send that across. We'll share it with the community.
Thank you. Thank you, Swastik.
I just want to be cognizant of the time, so I think we can wrap up unless anyone has any other questions. And of course, we can continue the conversation offline as well and explore like different options, like Abhishek was suggesting, trying to band together and get better rates.
Yeah.
Last call.
Question: what is Discord?
So, Discord is basically a Slack equivalent. The downside is it doesn't have threading. The upside is it has unlimited free history.
And audio as well.
Yeah.
Like something like Clubhouse.
Clubhouse on Slack, kind of a thing. That's what we basically use as the default platform for our community, the Turtle Money Circle. So all our content is hosted on Notion. And there we've got like the most expensive enterprise plan because that's the only way you can actually manage it. But we're like between Slack and Discord, we just on Discord, and we're actually trying to nudge everybody and consider this a pat on the back for everybody. Like, let's just get a little more active on Discord and conversations there. So that would be helpful. But yeah, that's what Discord is, firstly.
Got it. Okay, cool. Excellent.
Awesome. I think, yeah, Priyanka, we're
good to conclude. Yeah.
Yeah, so thanks a lot, Swastik and Hemanshu, for spending time and walking us through the intricacies and also a few higher level strategies and things to think through when we're deciding where we want to put our money. It was a great session, and we will follow up with resources, links, and articles that were discussed here, and promo codes, of course, which for the community members.
Thank you. Thank you, everyone.
Thank you all.
Awesome.
Thanks.
Thank you for being here.
Thanks so much, folks.
Thank you, everyone. Thank you.
Thanks.
Bye.